Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Fibonacci Retracement Levels, a beginner's guide to smarter trading. Traders are always on the lookout for tools that can help them predict market moves. Fibonacci retracement levels have become a popular choice for spotting potential price reversals and entry points. Based on a sequence from mathematics, these levels offer a simple way to analyze trends and make smarter decisions. Whether you're new to trading or refining your strategy, understanding how these levels work can give you an extra edge. What are Fibonacci retracement levels? Fibonacci retracement levels are a tool used by traders to predict price movement in financial markets. By applying a mathematical sequence to price charts, these levels help identify areas where prices might pause or reverse. If you've ever wondered how traders spot key support and resistance points, Fibonacci retracement levels might hold the answer. The concept of Fibonacci sequence in trading. The foundation of Fibonacci retracement levels comes from the Fibonacci sequence, a mathematical pattern where each number is the sum of the two preceding numbers, e.g., 0, 1, 1, 2, 3, 5, 8, 13, and so on. This sequence appears naturally in nature, seen in everything from flower petals to seashell spirals. It's fascinating how something so simple yet universal has made its way into financial markets. In trading, Fibonacci numbers are used to measure and predict price movements. The idea is that markets often move in waves, similar to patterns seen in nature. By applying certain Fibonacci percentages derived from the sequence, traders map out potential retracement levels. These levels represent zones where prices might pull back or retrace before continuing their original trend. Essentially, they're markers for spotting potential decision points in the market. Key Fibonacci ratios used in markets. Fibonacci retracement levels are based on specific percentages that come from the sequence. The most commonly used ratios are 23.6% a shallow retracement level, often seen in strong trends. 38.2% a deeper pullback, frequently indicating a potential continuation point. 50% technically not a Fibonacci number, but widely included due to its significance in market psychology. 61.8% known as the golden ratio, this is one of the most reliable and watched levels. 78.6% a level indicating deeper corrections, hinting at potential trend reversals. These percentages don't magically predict the market but instead act as reference points. Traders look to see how prices react around these levels, using them to make better informed decisions. For instance, if a stock retraces to the 61.8% level and shows signs of reversing, it might signal a good buying opportunity. Why Fibonacci retracement levels matter. At their core, Fibonacci retracement levels are about understanding human behavior. Markets are driven by buyers and sellers, and their actions often follow patterns. Retracement levels give traders a map to anticipate where these patterns may play out. Here's why they're important. Spotting key support and resistance. When prices stall or reverse at specific Fibonacci levels, these points can act as support, a floor, for falling prices, or resistance, a ceiling, for rising prices. Planning entry and exit points. Traders often use retracement levels to time their trades. For example, they might buy near a support level or sell near resistance. Combining with other tools, retracement levels gain even more value when paired with indicators like moving averages or trend lines. Think of Fibonacci retracement levels as road signs on a highway. They don't control the market's direction, but they can help guide your decisions and keep you from getting lost in the noise. How Fibonacci retracements are calculated. Understanding how Fibonacci retracements are calculated is essential for using them effectively in trading. The process involves identifying key price points and applying mathematical ratios to plot levels on a chart. These levels help traders spot potential reversals or continuation zones, making them a valuable tool for decision-making. Identifying swing highs and swing lows. Before you can calculate Fibonacci retracement levels, you need to locate the swing high and swing low on your chart. These are critical points that act as anchors for drawing Fibonacci levels. Swing high. This is the highest price reached before the market changes direction and begins moving lower. Think of it as a peak in price action. Swing low. This is the lowest price reached before the market reverses and starts moving higher. Essentially, it's the valley in a price trend. These points are more than just highs and lows, they represent significant shifts in market sentiment. Traders use them to measure retracement levels because they mark the start and end of a price trend. For example, if you're analyzing an uptrend, your swing low will typically be where the trend began, and your swing high will be the highest point before a pullback begins. By identifying these points correctly, you create a clear framework for mapping Fibonacci levels. Drawing Fibonacci retracement levels on a chart. Once you've identified the swing high and swing low, the next step is applying Fibonacci ratios to your chart. Most modern trading platforms include built-in tools to make this easier. Here's how you can do it step by step. Select a charting tool. Open your preferred charting software and locate the Fibonacci retracement tool. This tool automatically calculates and plots the commonly used Fibonacci levels. Anchor the tool at the swing low. If you're analyzing an uptrend, click on the swing low point to start drawing. This point serves as the base of your retracement measurement. Drag to the swing high. Extend the tool to the swing high point. This marks the full extent of the initial trend. For a downtrend, you'd reverse this process by starting at the swing high and dragging to the swing low. Observe the levels. The tool will plot horizontal lines at key Fibonacci percentages, like 23.6%, 38.2%, 50%, 61.8%, and 78.6%. These lines now represent potential areas where the price might stall, reverse, or gather momentum. For instance, if a stock is currently retracing after an uptrend, and it reaches the 38.2% level, traders often watch closely for signs of a bounce back toward the original trend. If the price continues lower, the 50% and 61.8% levels become the next points of interest. It's important to note that Fibonacci retracement tools don't predict the future, they give you probability zones. These levels need to be confirmed by other signals like candlestick patterns, volume changes, or trend lines. By mastering the calculation and application of Fibonacci retracement levels, you can add structure to your trading strategy. Practical applications of Fibonacci retracement levels. Fibonacci retracement levels are more than just lines on a chart. They can help traders improve their timing, decision-making, and overall strategy. Below, we break down how to effectively use these levels in real-world scenarios, combine them with other tools, and avoid common mistakes that can lead to costly errors. Using retracements to identify entry and exit points. Fibonacci retracement levels are incredibly helpful for spotting ideal places to enter or exit trades. Here's how you can incorporate them effectively. Look for confirmations at key levels. Watch how the price behaves around Fibonacci levels like 38.2%, 50%, or 61.8%. Does the price hesitate or reverse? These signals can guide your trading choices. For instance, a bounce from the 61.8% level might indicate a potential entry point. Set stop losses strategically. Place stop losses slightly below a key Fibonacci retracement level, like the 61.8% or 78.6%. This way, if the trade goes south, your risk is limited without cutting off too early. Use retracements to ride the trend. In a healthy trend, retracements provide buy the dip or sell the rally opportunities. For example, in an uptrend, entering around 50% retracement might allow you to catch the next leg up. Target profit zones with extensions. While retracement levels focus on pullbacks, combining them with Fibonacci extensions helps set profit targets. Once you've entered, look for an exit near a 161.8% extension level for maximum returns. For practical application, remember, fewer levels often mean less noise. Focus on meaningful ones like 38.2% and 61.8% for better clarity. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.